So let's take a look at some of the losers. The worst performing asset class in the last 18 months, surprisingly, has been preferred shares in the Canadian markets. So even though they're far safer than common shares and they're far safer than private equity, they performed far, far worse. So the price back in January 2015 was almost $12 a share. This is for our own pool, but this is true for all preferred shares. And all through the year, it kept falling, $10, $9, and eventually under $8. Now we're looking at something that basically is a drop of almost 40%. While the price was dropping, the thing to remember is the yield is going up. It's going the opposite direction. Those preferred shares were paying a 4% coupon in January 15, which rose to a 6% coupon by February and March of this year. So even though the price was dropping, the cash flow that you were being able to get was going up. So the question is, all right, well, why did this supposedly relatively safe investment crater like this? There were two reasons. The first was that as interest rates overall came down, it required the companies that had preferred shares that were able to reset their rates. They were going to be able to renew their preferred shares that were originally paying a 5% dividend. They could renew that at 3%. Well, the market didn't like that, so basically it simply dropped the price of the preferred shares until it worked out to 5%. And that was exacerbated by the fact that all the major banks, because of the Basel Accords, had to increase their capital. Now, all the major Canadian banks are very good credit. So if they want to borrow money at 2.5% or 3%, it's easy for them. But that doesn't count as banking capital. So they went to the marketplace and raised some money in preferred shares, paying a 5% coupon. Keeping in mind, preferred shares are not deductible. So for a bank to pay 5% is like it's borrowing money at almost 7%. And it knows that it doesn't have to borrow money at 7% because it can go and borrow money if it can borrow in the debt markets at 2.5% or 3%. So in this case, the banks set the standard for what the minimum coupon had to be, and that drove the market for all preferreds down. But it also meant there was great value. The prices were down 35%, the yields were up by 50%. The taxes are 20% lower on preferred shares than they are on interest income. So essentially by February, March, the coupon on a preferred share was equal to an 8% bond with nowhere near the risk that an 8% bond would actually have, right? But it was a very volatile market, so people were bailing out when in fact they should be bailing in. So our view is not only do we think that the coupon is very sustainable and very unlikely to be at risk at the current rates, but we think there's a great chance of price recovery of these preferred shares over the next 5 years. Another category that took a bit of a hit last year, maybe not quite so much, are high-yield bonds. Here, what you're looking at is my own portfolio of high-yield bonds, which are in my RSP. And in this period of time, between July and February, the price dropped by 15% of the bonds. That was simply a reflection of equity markets. People were worried about credit risk. But while that was going on, I was getting a dividend, or in this case, an interest payment every month, which was going back in. So this is part of the reason you can get better returns. Dollar cost averaging means something is occurring every month that forces you to buy. So when the price is lower, you're buying more shares or more units than when the price is higher. That automatically helps to make your longer term bit better. So over the years, this pool has generated for me, since 2009, almost a 6.5% coupon. In this interest environment, I think that's great. And currently, the coupon is almost 7.5%. So these are two examples of an asset class that dropped in price that one should not only not be afraid of that drop, but want to add to it. Use the other markets that have performed well to add to these. So in order to kind of give you a real sense of exactly how this principle works, in 2008, when the financial crisis really was getting rolling, I decided to, I'm not sure why I decided to do this, but I decided to write or do some research about what it would have been like to invest in the 1930s. Because by the end of 2008, people were calling this the next Great Depression. So I was saying, well, what if it is the next Great Depression? How will this affect our clients? So this was a quote from Warren Buffett at the end of 2008. He said, they, investors, should try to be fearful when others are greedy and greedy when others were fearful. Now, he said that when he invested $10 billion in GE Capital and Goldman Sachs, keeping in mind these two companies, nobody was going to lend them money. So he ended up getting preferred shares in those companies. The coupon, I think, was 10%, and they were convertible, so he got a significant upside. Needless to say, 5 years later, he's looking pretty good with that decision. But two things were true about Warren Buffett at the time. The first is he could actually write the check, which means he had enough cash and enough reserves to do so. And secondly, he understood the companies weren't the problem, the markets were the problem. The companies were solid. So depression investing, bad news, bad headlines all over the place. The question is, how bad were the 30s? So the S&P 500 dropped 83%. If you're thinking about 2008, it was a big drop, but it was about 50%. Dividends dropped by 50%. The permanent recovery in the stock market took 26 years, 1955. Unemployment rate was 25%. Thousands of banks failed. There was no deposit insurance at all. No Social Security or CPP. No unemployment insurance either. Prices dropped. Inflation fell by 25% over 4 years, and the national economy shrank by 33%. So the point of this is that 2008 crisis was nothing like this. It was not even remotely close to this outcome that occurred. So my question was, all right, let's take a look. How would it have been if you had $100,000 in 1929 dollars, which is worth about $2 million today, and you somehow, maybe you got an inheritance, and it just so happens it's 1929, and you've got to invest the money, and the question is, how are you going to do if you're so unfortunate to have that kind of timing? You know, you've got to invest the money, you want to get an income from it, you're retiring. So we're going to look at a particular mythical couple called John and Martha Kent. Some of you might remember the names. So there was a movie about them. And as you can see, they're in their backyard, they come from Kansas, they hear a big noise in the backyard, they run out to the backyard and they find a baby. And the nice thing about this particular baby is it came with its own uniform. And it was absolutely, it was a great, it was the alpha male of its preschool class, with that kind of speed and strength, flying and all of those things. So needless to say, they had $100,000 and they had to invest it. And what we were trying to do was see how close to our own portfolio we could get in the 1930s. So we basically arbitrarily picked a third of the money was to be invested in equities, because we can't get any, so these are public equities. This is the case of the US equities and the S&P 500. 30% in fixed income, which is really corporate bonds back then, and 30% in real estate. And we used these databases called the People History and GlobalFinancialData.com to do the calculations from then to now to see how this all played out. Now remember I mentioned that the stock market dropped 83%. So what we're going to do here is take into account things like inflation and all of the other things to see how the portfolio performs. So the first thing is, it does drop, this portfolio. So it's not immune to price drops, but it only drops 11% versus 83% in real dollars. In fact, it's worse off after the war because of inflation. And the capital is preserved during the entire 25 or 26 years we're looking at here. The most important thing in this portfolio is this, though. Its job is to pay an income to Jonathan and Martha so that they can raise little Clark to go to university and become a superhero. So let's look at the income. The income in this case is between $4,000 and $5,000 a year consistently. At no point does it ever fall below that. So essentially, in today's dollars, based on inflation, that's an income of $80,000 to $100,000 a year, inflation adjusted. So essentially, they really had no issues, with nothing to worry about in this portfolio because those checks continue to come in based on the diversification of the asset mix. And you've got to remember that this portfolio had to survive the Great Depression, then it had to survive World War II, and then the first 10 years of the Cold War, which is far tougher than any environment that most of us can imagine. So I thought, okay, well, let's take a look. Let's say that they weren't retiring. Let's say they decided they wanted to keep working and they wanted to just let the money accumulate so they could buy Clark a very great university education when he grew up. So in this case, the person is not retired, using exactly the same portfolio. The portfolio after inflation in this entire period of time grew by more than 5% a year. Now remember what the last 15 or 20 years looked like for a typical balanced portfolio after inflation? It was around 2. This is in a far tougher period of time, and it is over 5. And the final analysis I wanted to look at was this. After 1956, the U.S. entered a golden age, and basically the economy in the U.S. has been pretty good since then. So how does this portfolio, that's what we'll call the Depression portfolio, compare to the same investments between 1956 and today, which is roughly a 60-year period of time? Well, the 60-year period of time is this period of time right there, and there's the picture of the Depression portfolio. The rate of return for the two portfolios, virtually identical. There is virtually no difference between the two. So the first thing is that I think that it's not the economic circumstances that create issues in the way people manage wealth. It is effectively the diversification of the actual portfolio itself, the asset allocation model, and the income that you are generating on an ongoing cash flow basis. And that's why we focus on these two things in portfolio design. So I'm going to just summarize that. So we talked initially about tax-effective investing, getting that asset allocation right, making sure that every year the rebalance, or actually every quarter that we do, you rebalance. But one of the important components of this portfolio that's different is real estate. And I would like to hand this over to my partner, Wayman Crosby, who's going to walk you through what we're doing in that space. Thank you.